and then you can just do page down whenever
Yeah.
you...
Thank you. So hi, good afternoon, and thanks to Jayati, Chandru, Siobhan, Adrina, Nicole, and all the people behind the scene who made this this conference possible. I know there's a huge effort which goes into these things, and I'm really glad to be here and learn from all of you. So I will present some thoughts on the evolving changes in the global financial architecture, focusing on multilateral policies as well as bilateral propositions emerging in the realm of development finance. So in the next actually 15 minutes or so, I'm going to focus on three main points. First, how to analyze the current proposals to transform the global finance landscape with attention to potential impact in the global south, of course focusing on the history of IFI policies in the global south countries. Second, how to frame the expansion of innovative instruments of finance, which based on evidence are better understood as innovative instruments of debt, in my view. Third, and finally, I want to propose that the changes to the financial architecture and the expansion of private finance instruments are yet another step forward in the securitization of the development agenda. Here, I want us to consider the term securitization for the duality of its meaning. So in finance, securitization is a financing technique in which income-generating assets are pooled and sold to third parties, which then uses them as collateral to issue securities and, of course, sells them in financial markets. However, securitization is also a homophone. It also has another meaning linked to security and economic warfare. In this context, the definition of securitization is the transformation of a political issue into an issue of security or a concern, thus enabling an extraordinary means to be used in the name of security. So securitization is also about the successful construction of an issue into an existential problem. Some examples include migration, securitization in the aftermath of the war on terror, and so on. So placed under this dual meaning, the securitization of international development and climate, as led by the IFIs, is about enhancing the lending capacity of Western donors, as well as reinforcing their hegemonic interests in order making. So I will expand these points in the last slide. The next slide, please. So first of all, I want to discuss four major initiatives in development finance, which will provide a concerted push for yet more structural transformation in global south countries. These include the MDB reform agenda, the Bridgetown, the 2023 Macron Summit, and the EU's Global Gateway. I could not include the UN's FFD space here because I had to send the slides, but I hope the broader analysis can also be read as that, which at least is largely reflective of what's happening at the UN, and I think Sherry Spiegel covered some of this already. So the so-called MDB reform agenda, of course, includes all MDBs, but here I'm solely focusing on the World Bank. And this reform agenda has a long history. So with origins of the latest reform in the 2013, when G20 made calls for banks to optimize their balance sheets, this call was aligned with the previous billions to trillions approach, the cascade approach, and laid emphasis on how banks can deliver more, take more risk without impacting credit ratings. The modality of how to achieve this transformation is a particular narrative which asks banks to make use of their callable capital, free up balance sheets, create headroom, as well as make use of hybrid capital, coupled with now enhanced contributions from member states. So these strategies of increasing member commitment as well as financial engineering has been accompanied by strengthening and expanding the bank's existing policies and platforms. So the bank now offers expanded access to its infamous catastrophe bonds. If you've read impact of these bonds, this is why I call them infamous. Insurance. It's also created a new private sector lab, which has 15 chief executives sitting on the board, which include BlackRock, Macquarie, Tata Sons, Standard Chartered, and so on. The private sector lab will also focus on scaling an originate to distribute model that can provide baskets of investments to institutional investors. This investment lab is accompanied by a new global challenges programs, so that's enhanced country level partnerships, which is still evolving. It's also accompanied by expanding the guarantees platform governed by MIGA. So this will triple the World Bank's annual issuance by 2030. This is a significant change, as until around 2018, only 10% of IFC's portfolio was focused on guarantees. So these proposals complement and amplify the World Bank's previous calls for finance securitization. Securitization was a tool through which institutional investors could be crowded in to invest in the G20's proposals to make infrastructure as an asset class. So the idea was that the Global South policymakers need to reorient their financial markets to attract global institutional investors to invest in infrastructure and public utilities, which, of course, a host of these were privatized following this policy. And the current MDB reform amplifies this even more. MDBs are adding resources as well as securitizing private sector loans, whilst also mediating and responding to the risk-return profiles of institutional investors. Of course, this is happening in the climate of scaling back of official development assistance combined with the turn to commercial investors. So in a way, the MDB's role as engines of public finance is now shifting to engines of commercialized agents willing to become risk bearers. Of course, the MDB reform was also accompanied by the Bridgetown Initiative, and I think it was quite remarkable in the fact that it was the first initiative from a Global South country, which was very welcome on a multilateral level. And in a nutshell, I think it spearheaded the Global South's own approach to having equitable access to commercial finance. The second version of the Bridgetown Agenda, the Bridgetown 2.0, is a very engaging read. And I think one of the important highlights of this document was that it challenges the mainstream concept of risk of investing in Global South countries by highlighting the scale of reward reaped by Global North investors. We spoke about this yesterday as well. And I think we need to take this point forward when considering Northern investors with or without the support of MDBs. But in general, the gains of Bridgetown are not very straightforward, especially since the proposals also underwent a lot of transformations. And ultimately, the proposal is quite aligned with the World Bank reforms, in my view, and it is a bit difficult to ascertain what shaped some of the watered-down asks of the proposal. Finally, the legacy of Bridgetown and the implementation of the Loss and Damage Fund in its current governance was not the original proposal, but this is how things have shaped. In short, from a Global South perspective, the question is really if representation of certain Global South countries actually eliminates the structural problems of World Bank operations beyond the issue of governance. So there's a lot of criticism that reparations were not even considered in this proposal. Last year was also the time for the Macron Summit, in which development finance was a priority. This was actually an ad hoc summit with no space for binding policymaking, but it was certainly influential in norm setting. And I think it was quite successful in reinforcing the G7 consensus on fostering private sector development in green infrastructure, especially in tools such as blended finance. And of course, it had influence on the G20 summit, which came later in India. I've also placed the EU's global gateway here because I think it also shows the ongoing emphasis on private finance. So the global gateway is, in a nutshell, the EU's reoriented approach to declining development assistance and a move into investment partnerships with Global South countries. It aims to mobilize around 300 billion euros over a 5-year period. And it's investing in almost 200 projects in Global South countries, EU neighborhood and accession countries, with an explicit goal of providing jobs to EU citizens through trade. The Global Gateway is also aiming to counter China's Belt Road Initiative and without providing, but of course, without committing any new resources. And the emphasis is on how to mobilize private investments as well as make changes to the EU's traditional development apparatus. So, for example, there's a very close coordination between export credit agencies and EU's DFIs now, and there is a strong partnership with US Partnership for Global Infrastructure and Investment initiative, as well as old allies such as Japan. So in short, the development landscape is not only moving further away from traditional development assistance, it is now firmly rooted in commercial finance, and the entire greening agenda is built around a system-wide securitization to mobilize investors at an unprecedented scale to deliver unprecedented private finance. Next slide, please. So there are numerous tools for mobilizing private finance. And I think a better understanding of these tools is essential to then understand what is being delivered and what is not being delivered. Thanks to Adrina, who's actually covered debt swaps for me, so I'm just going to focus on blended finance. And broadly, blended finance is the combination of public concessional development assistance with private or public resources, generally with the aim of mobilizing or leveraging development finance from other actors. And the unique thing about this concept, which is, well, it's not unique, but it goes to a lot of concepts, is that it does not have an agreed definition. So we did a report in 2014, and at the time there were almost 20 definitions, and now there are around 10. And you can look at the OECD, the International Energy Agency, and the IFC, and they have very different definitions. And just like the modality of public-private partnerships, blended finance is designed to leverage private finance using public or development assistance funds. And although the trends in blended finance declined during COVID, it is now set to expand through investments in green transition, and a lot of organizations, including the UNDP, IFC, and independent climate investor funds are looking at it, are working with blended finance. So I'm going to leave debt swaps because you've already discussed that, but I'll come back to a little bit in the other slide. Next slide, please. The two other instruments which are really coming up are green bonds, so-called ESG or sustainability bonds, as well as guarantees. So a loose definition of green bonds encapsulates bonds with various environmentally positive themes and commitments, for example, using all or part of capital for ethical, environmental sustainability projects. And they've been issued by Global South countries in the recent years. So for example, Indonesia in 2018, Egypt in 2020, and Chile in 2022. Finally, guarantees are a form of insurance to help a borrower, whether a national government or a subnational government, to obtain, our private sector, to obtain financing at better terms that wouldn't be possible without guarantees. In international development, guarantees are presented as a so-called de-risking instrument, which assures the borrower that in the event of a project failure, the burden of the risk will be absorbed by the development agency, an MDB, or a host state. And as already mentioned, the World Bank's new guarantee platform is increasing guarantees. Aid agencies like CEDA, of course, are also increasing guarantees as a substitute for development assistance. European Fund for Sustainable Development Plus, ADB, AFDB all have their separate guarantee portfolios. Next slide, please. So I think beyond the definitions, the impact of these financing instruments is really important. And to my understanding, civil society has done most of the work in highlighting the risks of some of these instruments, but I know a few academic papers are also looking at it. So first of all, for blended finance, it's actually always been pushed as a silver bullet for new development finance, but a simple fact is that the amount of finance associated with this tool has not been delivered. So in short, the instrument, first of all, fails to deliver private finance. But more importantly, the instrument necessitates that private sector investment is accompanied by return. These returns are linked to the privatization of public utilities, such as in the multi-investor, multi-donor project of Just Transition Partnerships in South Africa, where financing was made contingent on the privatization of Eskom, the energy company. And in Indonesia, it was also accompanied by demands for privatized decarbonization, which contravenes actually the Indonesian constitution, and civil society organizations and labor unions in Indonesia were quite active on this. Finally, there's a very interesting report which came out by Follow the Money, which looked at the Netherlands-based climate fund manager, CFM, which relies on blended finance model. And the report shows that for a 23 million euro investment, the fund manager actually distributed 2.3 million euros in salaries and bonuses in 2022. And in Djibouti for a wind turbine project. And if you think about the context of Djibouti, as the report very well highlights, 4 out of 10 residents have no access to electricity in Djibouti. And so the gains and the losses for one wind turbine or a couple of wind turbine projects is actually quite huge. Again, with debt swaps, I mean, this is a report by Latindad. Eurodad also has a report on debt swaps, which is worth looking. But I think something to really consider in the criticisms is that debt swaps are inherently rooted in conditionality. And I've been thinking about it a lot in terms of the nature of conditionality. Also, I was reading the UN's Oil for Food program a couple of months ago, the 1995 program, where oil was, the sale of oil was conditioned on food. The Iraqi economy, of course, was going through a very different context of extreme sanctions, but the paralysis was extreme, and this instrument was offered as a reprieve, but not really, right? I mean, we know what happened with that program, and the same kind of conditionality is now in all these instruments. Next slide, please. Yeah, so very quickly, there's also a Eurodad report on green bonds, and I think Karina mentioned this yesterday as well, that they're different from ordinary vanilla bonds but they also build on them. So in vanilla bonds, fiduciary duty is linked to the maximization of return, whereas in green bonds, there is a very, very high, or it embeds this idea of ethics, conservation, and morality, a sort of trend which became very mainstream after the 2008 financial crisis. And it's linked to metrics such as ESG indexes, all of this which are voluntary. And the main critiques of this is, first of all, there was no strong evidence in greenium, so lowering of interest rate wasn't possible. A lot of greenwashing, as we see in a lot of other ESG instruments, and lack of transparency. Finally, with development guarantees, I mean, they are unmaterialized financial flows, and they are very ambiguous when it comes to reporting. So are they being reported as ODA under the private sector instruments, or are they guarantees which are somewhere afloat? But one of the main problems is that where a guarantee covers only a small share of total project cost, it's actually difficult to ascertain that it played a crucial role in the decision to make the investment. So this is one aspect, but the MDB playing a central role in guarantees is more liquidity, more lending, but to what ends? Next slide, please. So I want to make just basically 2 points in this last slide. The first is that the current institutional reforms and the expansive use of innovative instruments of finance are rooted in a linear and a very dogmatic vision of the financing gap, which designates all developmental problems of the global south to the scarcity of finance without any introspection of the quality and nature of finance provided. And growth enhancement policies in global south countries cannot advance without reversal of growth hampering policies. And the global financial architecture predicates on how securitization is streamlined. And this also brings us to the second meaning of securitization, which entails a transformation of subjects into matters of security, as I mentioned. And in relation to this aspect, there are 3 things worth noting. First is that an expansion of lending without actual reform of banks' approach to poverty alleviation is actually reinforcing the existing problem. So yesterday, Chandru mentioned Ghana's 1.20 billion stability fund. The point is to provide liquidity to Ghana's financial institutions. If the World Bank is the financier, we're back in that cycle. And how do you rectify all these problems? The second is the response to more lending without addressing the escalating debt crisis also needs to be juxtaposed with the decline of the current US-led order. Rise of alternative development financing mechanism, including BRICS. So a bigger World Bank, more private finance, more instruments create a dependency, which is also about the vulnerability of the traditional development finance institutions. So an inherent instability experienced by the current colonial order. Securitization of development is also attempting at ring-fencing northern investors against China, which is visible in the escalation of securitization of the AIIB, the Asian Infrastructure Bank, and the BRI. And finally, we also need to account for the militarized role of development finance. We can see that in the entire G7 being concerned with rolling out aid and concessional finance to Ukraine with no comparable measure to support any other countries. The European Investment Bank is also changing its approach to lending for Europe's own military industry. So the EU's public bank is taking an explicit turn to fund EU's military ambitions. Finally, we cannot speak of development finance without centering the genocide in Palestine and the escalation of war in Syria, Lebanon, and Iran. development finance is increasingly becoming commercial finance, and commercial finance is increasingly diverted towards financing war, privatizing every aspect of life, including dissent. And finally, I don't think I have time to go into this, but I think we need to be careful when we talk about certain financial terms such as de-risking. A colleague, Pon Swanson, who's based at Bentley University, actually pointed it out, that de-risking as a term is a financial industry term, now commonly used in academic analysis, but the concept has limits because it's not concerned with the political role of the state in subsidizing the private sector and also seeking equal compliance from global South countries. So it's almost like it's happening in an atomistic vacuum, which I think needs more criticality. In a context of debt crisis, imperial hegemony of the dollar, a reverberating impact of sanctions in the global South, instruments of debts such as blended finance and so on have an extremely negative impact in global South countries. And I think this creates a situation of siege because there is self-imposed austerity. We saw with Isabella's presentation what happens to pension funds. And in a way, it's about guaranteeing a future for the private sector, but not for the global South populations. And in this sense, I think we go back to Richard's provocation about how to move forward. And I think the point here is about collectiveness of global South countries, about more South-South cooperation, and more political will as opposed to any economic or empirical analysis of the situation. Thank you.